Robust CPI and PPI readings make a 50 basis points rate cut highly unlikely. Welcome to Market Insight. I'm Ludovica Brignola. The core reading for August Producer Price Index came in ahead of forecast on Thursday, following a steady CPI print the day before. Signs of economic health mean the Fed is now almost certain to cut rates by 25 basis points next week, rather than 50. So where do markets go from here? Well, joining me now to talk about all that is Randy Watts, a Senior Portfolio Manager for O'Neill Global Advisors. Thank you for being with us today, Randy. So a 25 basis point cut has been priced in for a while now. Do you think disappointment that there won't be a greater stimulus is the reason we've seen relatively muted trading on Wall Street, at least so far today?
I think there's two reasons. First, as you said, the market's now forecasting an 85% chance we're going to get 25 bips next week. Though it's funny, in the November meeting, the market's split right now. Right now, it's got a 47% chance of 25 basis point cut and a 46% chance of a 50 basis point cut. I think equity investors have started to shift a little bit from being really obsessed with what inflation data is doing to really now starting to worry about the labor market. So I think one of the things that's affecting equity markets today is the fact that initial jobless claims rose for the first time in 3 weeks. When you combine this with the revisions downward on jobs a couple of weeks ago, I think equity investors are worried about how fast the labor market is slowing and what that could mean for the U.S. economy.
Well, then, keeping an eye on the labour market, as you say, we've had analysts at Wells Fargo today saying that next week's cut will be followed by 50 basis points cuts in both November and December. Is that your working assumption as well?
I think the Fed, it was very hard to get this ground on rates for them over the last couple of years, coming from where they came from, basically zero. So I don't think they're going to be willing to give back all of the interest rate increases immediately. But over the longer term, I do think rates are coming down quite a bit. On a real basis, the Fed is restrictive. If you look at what markets are pricing right now, markets are pricing actually about 2.5% of rate cuts over the next 12 months. So I don't think the Fed is going to move initially to doing 50 basis points. I do think the cuts are going to be on a pretty regular basis going forward over the next 12 months.
Right. And then these assumptions about rates, how are they feeding really into your decisions for the fourth quarter and beyond? And I mean, I'm talking about equity markets, but also more broadly capital markets in general.
Well, stocks are still relatively expensive. If you look at the S&P right now, it's about 23 times this year and about 20 times next year. So it's not cheap. Short term, we are a little worried that maybe earnings estimates are a little ahead of where they're actually going to be in terms of results. But if you think about stocks on a longer term basis over 12 months, 85% of the time, once the Fed starts to cut rates, stocks are higher 6 months later. So, the golden rule of investing is don't fight the Fed. Well, I think there could be some near-term volatility, especially with the election and, like we said, a softening labor market. We're pretty confident that a year from now, stocks are going to be higher.
Right, and since you've just hinted at the elections, I mean, how much of a factor do you think the election will be over the next few weeks?
I think it really depends on the outcome. Markets actually do best under a split government. I think if there's a split government, which means different party controlling both the House or the Senate and the presidency, I think markets will be fine. I think a sweep in either way could be dramatic for the market, but that's not what we're anticipating. So I think once the elections are behind us, equities have a little bit of a clearer path to rise. And at that point, the Fed will already have been cutting rates for a couple of months. So I think that actually is a pretty benign outlook.
Right, and apart from the elections, that will be an important factor that will have impacts on markets. But I mean, what are the other variables you think investors should be keeping an eye on?
I mean, I think obviously labor. I think the fact that the dollar has come off its peak and is now cheaper now relative to other currencies, that can help international earnings over the next year. And then oil, right? Oil's below $70 now. That has a real impact on the U.S. economy. If energy prices stay low, that could actually act as a stimulus over the next 12 months.
Thank you very much for all these insights, Randy Watts O'Neill, Global Advisors. Thank you very much. And that's your Market Insight. Don't forget, you can watch more videos on Reuters.com.